So you've heard, I'm going to just work here, you've heard an overview of the economy. Look, it's undoubtedly the case. It's been a desperate year. You know, you read the Financial Times. I remember one Saturday a couple of years ago, they were looking back at 22 and they said 30 trillion had been lost. And this had been following a decade of the Dow and the Nasdaq just the bear, the bull just kept roaring and the bear wasn't visible. So I want to ask you, what's your sense of the market now in terms of, you know, a 15% drop in pension assets in Ireland? The January figure from the CBI is worrying. If I, you know, we've spoken about the overall situation. I know you take a long-term view and a diversified view, but even by those standards, is this a problematic time, Joe?
And by that you're talking about our pension scheme members, and obviously there, as Rose mentioned earlier, a lot of trustees here who are responsible for safeguarding those assets. It is very much a long-term strategy for pension scheme members. So you're absolutely right. Last year was was probably the fourth worst period for equities since the Second World War. It came after a 13-year bull run. But the point is that is for the investment manager to navigate. If you are a member of a pension scheme, you're investing over perhaps a 30-year period, and therefore you must stay in the market. You have to deal with the volatile periods of time. You know, when we spoke earlier about inflation, one of the challenges really with inflation is that it erodes the value of your pension when you get to retirement. So therefore you need to be investing in real assets. You can't actually time the markets. You can't move in and out. You must stay in the market. So it's about time in the market, and the longer the better, rather than trying to time it. It is a challenge for investment managers. It's up to investment managers to manage that. And you know, we probably will go through, you know, challenging 2023, and active investment management is going to be important, making sure you pick the right companies, those companies that are going to be least affected by inflation or whatever. So, you know, that is the investment manager's job. You need to trust your investment manager, and you need to stay in the market if you're a pension saver. And the other thing just to point out is that every pension scheme must have a default investment strategy. And you know, it's important, as well as the investment performance, as mentioned earlier, you need a good investment strategy, one that ensures that when you get to that point of retirement, that you're in the right fund given your risk profiles. So typically, if you have 20, 30 years to go to retirement, you should be in more high-risk assets like equities. As you get closer to retirement, you should start to de-risk. The investment strategy will deal with that, and it shouldn't be a concern for the member. Now, we do know people will be getting benefit statements now in 2023. They might see, as you referred earlier, they'll see a reduction in their the value of the fund, perhaps compared with last year. But if you look back over the last 10 years, and one of our flagship funds produced an annualized return of 7.7%, that would be in excess of inflation over that period. So you can't just look at 1 year, look at the inflation, look at the performance of your fund. You need to look at it over the long term. So, you know, our message to pension scheme members is, you know, you're in the right fund given your age profile and your duration to retirement, and you need to stick with that. And we will eventually de-risk you over the period to retirement, and leave it up to the investment manager to make those short-term decisions to maximise the long-term return.
The other, leaving aside what's happened with equities and tech stocks, the other thing I want to talk about is the bond market, because bonds in the low inflation era give very poor, you know, stable but poor return. You know, with the raise in interest rates from the central banks and the Fed and so on, is the bond market becoming more attractive or not, or what?
Yeah, absolutely. And I guess, you know, probably the investment managers will now look to maybe move back into bonds because they're becoming more attractive. But in the long term, our focus is really on providing multi-asset investments. So therefore, you need you need, I suppose, a lot of liquidity. You need to invest in equities and bonds, perhaps more bonds as you get closer to retirement. And I suppose maybe Graham might have a better view on specific assets, but it's important really, I think, to have some diversification in your fund. And we would move, part of an active investment manager's role is to move between equities and bonds depending on the opportunity. But again, back to the point earlier, from a pension scheme member's perspective, they should stay in the investment strategy that they have been.
And just on what you said for Zurich now, Zurich, it's about 30 billion of assets that you manage. What proportion of that would be in a default fund?
I would, first of all, that it was about 32 billion. It's not all in pension assets, but of our pension assets, about 90% of pension scheme members would be invested in a default strategy. Those other 10% of people maybe make their own choices, and therefore it's up to them, obviously, to make those investment decisions. But I would say 90% of people are quite happy to leave the decision to the trustees and the investment managers.
Okay. So if Zurich and Amundi are on the money inside, you're on the money outside in terms of venture capital as a possible repository of their investment funds.
That's right.
How does the world look to you, Q1 23?
Now, I don't want to be too optimistic and too upbeat, but for us, we're in some ways a counter-cyclical industry. And last year, so far, Q1 to Q3, investment into Irish companies is up by 25% year on year. It topped over $1 billion, and they are growing unquoted, unlisted companies. And our members invest in risk capital in those. And for us, a recession is actually a really good time to build a business. The biggest issue for a lot of the scaling companies, those that are based in Ireland, raising Series B and Series C, has been talent and competing with the multinationals that are here. So while at a personal level, it's never good to hear that somebody is losing their job, at an industry level, it is great that people will be leaving that warm embrace of the corporate multinational and maybe taking more risk or in their careers and joining a startup. So the world, looks good. We expect into next year that we'll start to see some of the impact. Anybody raising a fund, this is not a good time. But if you have raised a fund in the last couple of years and you're investing, then the onus is on you to get that money out there and get it into great companies. Where we would see a real issue, 50% of the funding that comes into our members' funds comes from overseas, and that funding, trade has been weaponized in the last couple of years, and the last year in particular. The global consensus on economic growth and stability with the war in Russia has been upended. We started to see it with Trump and the interactions with China. So, where we worry in the long term, and one of the reasons we're here today to speak to this group is, that funding of growing Irish companies. The ability to attract money from overseas is going to change in the years to come. But also the wisdom, when we look at the next battlefields and, the things that are coming down the line. 40 years ago, our economy didn't look like this. In another 40 years, the technologies that are being invented today, blockchain, AI, deep tech, they'll be the economy of the future, but also the potential battlefields of the future. And allowing outside interests as a small open economy at the very edge of Europe, if you don't have your own champions in these areas and if you can't fund those enterprises locally, you're leaving yourself really at a significant risk of decisions made elsewhere and decisions that may not be made in the interests of Ireland. And today less than 1% of assets under management are invested in Irish VC and private equity funds, and we would definitely feel that now is the right time to look long term at our economy. And ask this industry and the people in this room to invest in future jobs, the jobs that we can't see now. At the moment we're at the mercy of decisions being taken in Silicon Valley with a lot of the US companies that are based in Ireland. How can we grow our own champions? And if 50% of the capital that's going in, particularly to scaling enterprises, is coming from overseas, those companies that are taking their first steps here, that are really promising, that are based on a very high talent, high tech economy that we have here at the moment, that we're growing really great companies and building them. But as soon as they take their 30 million or 50 million from typically the US or China, their board is built out there, their next steps are there, and they're not the Irish companies that are going to be
I very
here
much
in the future.
Get the green jersey point and autonomy and control, but I have to stress test this a little bit because I've been through 8 recessions, and I would say that one of the things that happens is there's a flight to scale and a flight to quality. And, Microsoft and Apple and Facebook and Meta and Amazon and all of those might be down 20-40%. But you know what? The revenue may be still growing. They have PE ratios, but they need to sort out their profit. Maybe they're expanded too fast or whatever. But sometimes when the big corporates get influenza, the startups get pneumonia. My point is this: maybe the reason why it's 1% is there's inherently more risk. Now, angel investors will tell me, if 1 out of 10 companies becomes a Facebook, it doesn't matter about the other 9. So what's your answer to the risk question that, there's a huge fiduciary responsibility on Joe and on Graham not to lose money, whatever about not making enough money? How do you answer that point?
Well, I mean, I think the first thing, I would agree entirely. Nobody wants all of their pension fund invested in, in extremely risky assets, and they are risky. The typical venture view of the world is if you invest in 10 companies, you're likely to lose 3 of them. You are hoping that 3 will return the fund, and then somewhere in the middle, and you're really hoping for that one that is going to, to explode. The returns are good, and they have been good. The big issue, I think, in terms of attracting investment, institutional investment, and the type of patient capital that pension funds provide, is liquidity. It isn't risk. The move from defined benefit pensions, and particularly semi-state defined benefit pensions who did invest in VC, towards defined benefit, and the needs for daily portability and liquidity have stopped the level of investing that previously existed in venture capital. To be honest, the returns are probably better now. It's a more mature industry, and the companies are bigger and scalable than they would have been when those semi-state pension funds invested in the past. So I think the issue is around, and it can be done. I mean, it's been done in Denmark. There are mechanisms, there are vehicles, there are ways to overcome the liquidity issue, because yes, if you invest in a venture capital fund, your money is tied up for at least 10 years. But there are mechanisms and ways to overcome that, and I don't think risk is the overriding issue.
Okay, Graham, talk to me first of all a little bit about Amundi. We heard from Zurich they have 32 billion of assets in total. They're the second largest life and pensions operate over 15% of the market. Amundi are very big in Europe, but a fairly new entrant in Ireland. What's your footprint in Ireland at the moment?
Yeah, so we've just over 40 billion in assets in the Irish market. Domestically, we're just over 10 billion now at this point. We're the largest asset manager in Europe, and we're the only European asset manager in the top 10 globally, so we compete with all our American colleagues. We do have a massive footprint when it comes to the pension market. So, one of the benefits we do bring locally in Ireland is our global knowledge of the pension market, and in a time when auto-enrollment is being brought to the Irish market, we're talking about global standards when it comes to pension schemes in Ireland, etc. We feel like we have a lot to offer and support in that sense as well, Ivan. But look, we're like the small farmer. We're trying to grow. We're trying to build ourselves up from the bottom. We're trying to make a name for ourselves.
Small farmer's always starving.
Yeah.
But okay. I get the picture. So I was talking to Joe about post-pandemic,
Yes.
Post, we'll say, a nosebleed on tech stocks. Where do you see asset allocations investing?
Yeah. So I just want to make a couple of points on this and bring in something that we've done recently. I know I mentioned this last time we spoke, Ivan. We conduct this survey called Your Planet, Your Future. It's basically we interview over 1,000 people in Ireland from all different socio-demographics, backgrounds about what their view of the world is from a responsible investing point of view, what they know, what they don't know. Just one point on that, because I think it's relevant to the discussion today. 84% of the people from that survey across all socio-demographics in Ireland said they were concerned about being able to sustain their standard of living in retirement. So this is a huge topic anyway, and it comes back to returns. So when you bring that back to what we do from an investment manager point of view, last year, and we've spoken about it at length at this stage, was a very difficult year. Last year was the year that diversification broke. Of the 30 different areas you could invest in the market, from equities to bonds to cash, etc., 24 of them were negative last year. So there's only 6 asset classes you could have invested in that would have delivered you positive returns. Commodities, energy companies, and the dollar. Does that mean that diversification is broke into the future? Absolutely not. So when we stand here today and look out into the future, we do see opportunities again in bond markets, certainly emerging given where interest rates have gone. We see opportunities to diversify even more within the bond market now. You're getting very, very good access to corporate credit, very strong companies who are offering very attractive yields where you wouldn't have been able to get that a year or 2 years ago. But sometimes even in our industry, we try to make it complicated. We tried to talk about asset classes and diversify. And if I think back at the end member, what's the two most important things for any member investing their hard-earned pension savings? Time, and Joe mentioned this. Most pension investors have time on their side because they're 20, 25 years to retirement. And the second thing is going into the default fund. And I hate when we call it a default fund, because a lot of people say to me the default sounds like a secondary thing and not a great thing. I'm in the default.
It sounds like a safety net.
Yeah, and it sounds like it's something that's not really looked at. It's just you default into it. In actual fact, the default funds by all providers are probably the one fund that are built focused on helping you on your pension journey. They're the funds that are designed by the asset manager. They're the funds that they really look at and focus on. They're the funds that are diversified across different asset classes. And they're the funds that are designed to smooth the investment journey for any pension saver. And if you look at most default funds that have come through the global financial crisis, that have come through last year, etc., these funds probably outperformed in just investing in an equity market on its own, in stocks and shares. They smoothed the investment journey. But remember, because the pension saver is allocating money every month, they're getting averaging into the market as well. So that's another key benefit of being a pension saver. You're not putting all your money in 1 month, you're putting averaging in every month as well, and obviously getting the benefit of tax relief. So from an asset allocation point of view, from Amundi, when we look out, sitting here today, where do we see opportunities? We think we're cautiously optimistic. Equity markets to us still feel like there could be some potential volatility down the road. And what I mean is we think earnings estimations are still too high. We'd like to see them come down a little bit. So we do think that there could be some form of still a bit of correction in the equity market.
So the PE ratios will drop, you think?
Yeah, I think you've seen the price adjustment, but the earnings hasn't really come down enough for where we think, from a recessionary point of view, where we think interest rates have come to. And we expect to see that flood through into the market over the coming 6 months or so. So we do, for us, we are still a little bit cautious over the start of this year in relation to equities. But as the year evolves, we do think there's going to be some very strong entry points for equity markets as well. On the bond front, at the minute, we're very positive on core government bonds. US in particular, core government, Euro government bonds as well, and we do see opportunities there. But to be honest with you, for the first time in a very long time, lots of asset classes are returning positive yields now. Even cash, for example, which was negative yielding for such a long time, you can get positive returns from cash now as well.
0.5%.
Still better than the negative returns. And as a defensive asset class, that is something that you can play.
If the inflation is 8% and you're getting 0.5%, no, thank you, surely.
As part of a diversified portfolio alongside equities and stuff like that, remember, this is about smoothing the investment journey. So, we're not saying invest in one asset class. We're saying diversification, but now from your diversification, you're getting asset classes that before weren't giving you returns, which actually now are contributing and playing their part.
For trustees, Joe, we heard Rose speak about master trusts. Is this actually a bigger show in town than AE?
Well, I mean, look, I mean, the biggest challenge, and Rose did say it, is lack of coverage. And automatic enrolment is really important to, to encourage people to save for retirement. And coverage has dropped over the last maybe 30 years. I mean, for some people in this room, perhaps when they joined work, and you mentioned DB schemes earlier, Ivan, when they joined company, they were probably automatically joined a pension scheme. That was in a DB world. Obviously, all public servants end up in a defined benefit scheme. So what's happened over the years is we've moved from defined benefit to defined contribution, and it's become voluntary. So the auto-enrollment is essential to get people back into pension saving. Where I would see the role of master trust is that a lot of companies will already have their pension scheme established. And why would you want to be running an auto-enrollment scheme, also running your main scheme? So it's an opportunity for people to look at their scheme and make sure that, first of all, it's compulsory. You find a way you improve the member engagement, you get members into the pension scheme, and you deal with the compliance and the regulatory requirements through the master trust. So they do work hand in hand. We need more people to fund for retirement. They can do that now through the master trust and get ahead of perhaps an obligation to do so when auto-enrollment is introduced in the next year or two.
Anyone want to add anything about master trusts before we move on?
I just think they're a great addition to the market and where it will go. This idea, and Rose mentioned it, the fact that if they're all together in one group, there has to be efficiencies of scale, which will ultimately benefit the pension saver.
Okay, I want to talk, because every conference, and we will be dealing with it, takes a deep dive into ESG, and a lot of this is driven by EU regulation, SFDR, and so on. From your perspective of asset allocations, and including Irish venture capital here, it's actually interesting to note, I was at a conference yesterday where someone said, wind power and some renewable energy options are actually giving better returns, huge growth, and it makes economic sense, and so on. Is it all stick in terms of ESG, or is there a carrot as well?
Action follows money, and a lot of the LPs who provide money to our funds are European institutions. They're large organisations and governments and European institutions. And climate change is the biggest challenge that is facing any of us in this room, despite what we might think here today and what we might focus on. So, that money is pushing the green agenda, but
I suppose I'm asking, within your membership, is there an ESG suite of investments you can make that also tick the Green Jersey Irish box?
Yes.
And are looking to raise venture capital?
Yeah.
They're not quoted, they're not on a stock exchange, they're not a PLC.
No, exactly. That green technology, environmental technology is a growing share of the companies receiving funding in Ireland, receiving venture capital.
So if trustees find, oh my God, we've got to up our activity in the green area, it isn't incompatible with investing.
No, in fact, inventing new technologies that we can't even think of today is exactly what the companies that we fund are in the business of doing. So it's the right place to be for driving extreme change in that area.
We end up speaking on the ESG panel to people who are really committed to making this happen, telling you what the regulation meant. For hard-assed investors and people who are trying to get the best returns, what's your attitude to ESG? Is it that you're being forced into this and it's the right thing to do for the planet, or does it make economic financial sense?
Sorry, for me.
Yeah.
So it makes no VC will invest in a company that doesn't make financial sense. So, the challenge is probably at the company level to ensure that what they're coming up with and what they're offering is not only a solution, to the challenges that we're facing, but also something that's viable and makes money.
ESG for you. Right.
I think you can't get away from the fact, Ivan, that for a pension investor, they need to make returns. Okay, ESG is hugely important. Like from a personal point of view, for everyone in this room, climate change and how it affects us, it'll affect us as human beings. But from a pension point of view, it needs to deliver returns. We fundamentally believe that by improving your responsible investment within your default or your pension scheme doesn't limit your fact that you can make returns from it. This is where we believe the future is going, where we believe the industry is going. There's a bit of a stick on it. Let's call a spade a spade. As asset management, as asset managers, as holders of large assets, we engage with companies to try and help them improve. So you could argue that, as key shareholders in these companies, we're trying to drive this agenda with them to improve their sustainability, their carbon footprint, etc. But it's because we fundamentally believe this is the area that will drive returns for investors into the future. You look at where the US, European governments are going with the Green Deal, what's happening in the US now as well. This is only going to pump more money towards this area. For us, and I would say one thing just for the trustees in the room as well, I think it's important to really get under the bonnet of what ESG is. It's not just one homogenous pot, because I hear people saying, listen, we need to add more ESG as part of our default scheme. But what does that mean to you? You can go into clean tech, you can go into carbon reduction, you can go into net zero. It's very complex when you get under the bonnet, and I think that's why it's really important to sit down with with the trustees and have a discussion about what you want when you incorporate ESG into the portfolio. But just one thing on that, because a lot of people would say to me, sure, people don't really care about it, right? Your Planet Your Future survey, over 70% of people want their pension savings to be doing good by the planet, right? If you ask a person, if you could put some of your hard-earned pension savings towards improving the planet and making some money, they all say yes. So it is something you need to think about, incorporate into your scheme. But I would just say it's not a homogenous pot. And I hear this so much. Let's just put some green stuff in there and it'll be grand.
It could be afforestation. It could be a wind energy farm. It could be some tech revolution,
And just on that point as well, Ivan, and this is really important. You mentioned solar and you mentioned wind. Not being diversified in the ESG space as well can expose you to boom-bust cycles. Like regulation changes with wind energy. Only a number of years ago, the regulation changes and everyone jumped out of wind because they didn't think the wind companies were going to be able to make money. Then it came back in the agenda again when China decided actually we're going to go big on wind energy and wind turbines, and the market saw as a growth opportunity again. So it's stupid, and I'll repeat myself 100 million times, because investing is very simple and it comes back to diversification. When it comes to ESG, that's the same principle. Don't be, deciding to jump on solar as your ESG strategy. Diversify.
Be diversified.
Exactly.
Yeah. Okay. And so that's it could be methane emissions on one side, or it could be a public transport investment.
Everyone's talking about hydrogen at the minute.
Yeah, exactly. Storage, batteries,
exactly.
all that kind of thing. What does ESG mean for you in Zurich?
Yeah, so I suppose we see ESG as a sort of an integral part of the investment process, and I suppose our view of responsible investing is that you do well and you do good. And I completely agree with Graham. At the end of the day, it's actually using ESG to enhance your returns. And one of the key pillars for us is this point about active ownership. So actually, if we're investing in these companies, we can influence those companies. We will vote at meetings that cover all of those ESG points. And for example, you take the G governance. Why wouldn't we, want to invest in a company that has good governance? That's been embedded in our strategy for the last 20 years. So it isn't about I think the investment community, providing capital to these companies, have an opportunity to influence them. So therefore, it has to be an integral part of the investment strategy, and the outcome should be a better result for members, because you'll be doing good for the environment, but you're also delivering better returns for members.
Okay. I always say on these panels, and do I have the Slido thing? Yeah, there it is. I knew I didn't have. If there are any Slido questions, so the poll is: do you believe auto-enrollment pension scheme will be introduced in 24? Very good question. Some of the questions, I'm just going to flick through them, and I'll let you take references to need for active management are not supported by a wall of evidence that active managers in aggregate underperform. Okay, I'm not sure whether you buy the index or, I don't know what that point is. Joe mentioned the importance of being in the right fund based on age, select the right risk exposure. I noticed the less riskier funds have lost more value than much higher risk funds over the period of 1 year. Does this advice still make sense? Is the amount DC members contribute to their pension not more important than the marginal differences in investment performance, provided inevitably probably true, whether you're given 6% or 2%. Welcome to the Pension Summit, exploring developments in new policy. Right. Currency movements, we didn't discuss that. The high value of the dollar was spoken about, sterling with its problems. Why did the central bank relax the 3.5 times limit to 4 if the problem is supply side? What effective? That's really for Mr. Malouf for those. Can Master Trust work for defined benefit schemes, investment assets, portfolio and climate change? What's the message to upcoming youth and future outlook? I think we covered this. What are the panel's opinion on PRSAs and government policy for funding and removal of BIK? Is the PRSA going to replace Master Trust pension funds in the future? I was actually speaking to Rose earlier about that. PRSAs are a very small part of the market, apparently. So, taking those questions, and you have your audience here. These people are in the coalface of all of this. Trustees, employers, a lot of important people in the room. I looked at the attendee list. I give you 2 minutes of what you think they need to know right now, starting with you, Graham. What's the most important message these people need to go away with from your perspective?
Yeah, so I'm not going to touch on the investment side of things because I think it's been well covered in diversification, etc., and we've had a number of things. I'm going to talk about ESG because it is extremely topical. I'll say just 2 things on this. First of all, when we use the term ESG or responsible investing, majority of people don't know what we're talking about. In our recent survey, only 13% of people understood what ESG meant. They didn't know what the term meant. We use it a lot as an industry, as an acronym, thinking, ESG investing, etc. We use it with end members and we use it with end investors. They don't know what we're talking about. 11%.
I've spent my whole career not knowing.
I don't either. And the term responsible investing, by the way, which is what we all thought was a great way of allowing people to understand what we're talking about. Most people think responsible investing means being cautious with your investing. They don't relate it to anything to do with climate change or enhancing our planet. So my point that I want trustees to take away from this is, because you're getting bombarded with conversations around responsible investing and ESG, take your time to understand what it means to you and your scheme. Your members are actively engaged in this area, whether you ask them or not. Most people who are contributing to your pension scheme want to do good by the planet. But I think it's important as a trustee, as somebody who's managing money on behalf of the members, to understand what you want from that ESG within that portfolio, and then understand it and then act on it as well. And the only key point I'd leave you on that is that be diversified when it comes to it. There's too many people who try to sell you something that's very specific.
Not every day you get an opportunity, Sarah Jane, to speak to this audience. What do you want to say? More than 1%, don't be dependent on overseas for your members?
Yeah, well, what I want to say, we heard a lot today about the dependency ratio that's coming down the track. What our members are about are building great companies that are based here in Ireland, and that can grow and scale here and provide employment. So if we look to the future, if you look 30, 40, 50 years down the line, who are going to be the Irish pension savers? We can see at the moment we are beholden to decisions that are made outside of Ireland. And when we heard about ESG, we heard about pension savings as a force for good. In this country, we don't have domestic multinationals of a scale to invest in venture capital. 50% of VC funding in the US comes from US multinationals investing to have a first look at new technology. We don't have inherited wealth passing through generations. We're missing a lot of the building blocks that would allow us to scale those companies here. So pension savings really are the only show in town to mobilise more capital to this sector and to enable us to grow great companies here and enable pension savings the savings today to create the jobs of the future in Ireland.
Your message from Zurich?
Yeah. And look, there was a comment there about active management, investment management versus passive. I think the point is that you need to choose a good active manager. Yes, it may very well be that some active managers underperform, because that's the point. And how active are they? But there is no doubt, when you know, go back to the conversation we had earlier around ESG and companies that you want to buy in to make sure that they are ESG compliant. You can't get in easily access that through an index. You need to get your stock selection correct. We spoke as well earlier about, you know, asset allocation. That's a part of active investment management. So there are many components to active investment management, and some companies are good at that, and perhaps some companies aren't active enough and underperform. But I wouldn't accept the case that active fund managers underperform passive.
All right. That concludes this adjusting portfolios to achieve returns in a never-changing world, post-pandemic and inflation. Please show your appreciation for Joe Creegan of Zurich, Sarah Jane Larkin of the IVCA, and Graham Fox of Amundi. Thank you very much indeed.